Well, good morning, everybody, and thanks very much for joining our webinar looking at the economic outlook, global trends and what they mean for the market. This is, as you know, part of a series of more Kingston Smith webinars looking to address issues businesses need to plan for over the coming months, and for which we bring together a panel of experts from across our firm and, delightfully today, from outside. My name is Mandy Merrin. I'm going to be chairing today's session. I am very pleased to be joined by Gregory Perdon, who's the Co-Chief Investment Officer at Arbuthnot, Latham & Co. Gregory, welcome. Gregory is going to take us through the economic outlook in just a moment. But first, as usual, we're joined by our Head of Tax, Tim Stovold. He's here to answer any tax questions and normally diligently taps away in the Q&A while everybody else is speaking, answering tax-related questions. I'm also joined by my partner, Paul Samrah, who is more Kingston Smith's Brexit impact specialist. Welcome, Tim and Paul. Just a little bit of housekeeping. Questions can be posted in the Q&A function. Please don't post them in the chat because it makes it incredibly difficult to work out if we've answered them or not. So questions posted in the Q&A functions. After the webinar, we'll circulate a recording, a copy of the slides and answered Q&A. Thank you very much to those who submitted questions in advance. We'll try to pick them all up. If we don't manage, we'll come back individually. On the subject of submitting things, if I can just make my normal plea, when we send round our slides, we also send round a feedback poll and would be really grateful if you'd take the 2 minutes needed just to complete it, because it really does help us make these sessions better for you. I'd now like to hand over for Paul for a brief summary on where we are on Brexit, and then Paul will hand over to Gregory for the main meat of today's session. Over to you, Paul.
Right, good morning, everyone. Thank you, Mandy. So the Brexit talks roll on. Let's get the fish puns out of the way nice and early. The fish talks are floundering, but that's not the sole stumbling block. Three main issues: state aid, governance and regulation. For service businesses, the key issues that remain: mutual recognition and equivalence, travel and mobility, and data transfer and adequacy. And for goods businesses, the prospect of tariffs, certification of origin issues, kite marks and labelling, CE and CA certification matters. To cap it all, I'm hearing now that bottlenecks are starting to appear at the ports. Felixstowe, Southampton, I have first-hand knowledge of, and I'm sure other ports are going to be suffering as well. There's been a lot of talk about the so-called level playing field and what the issues are surrounding that. Just to clarify that, it's a set of shared rules and standards to ensure that businesses in one country don't have an unfair advantage over another, over other competitors in other countries. Now, Brussels wants the UK to follow EU rules closely in areas such as workers' rights and environmental regulations, but the UK says the goal of Brexit is to be released from following common rules and to reassert their national sovereignty. So it rolls on. There is an EU leaders summit today, and we'll see what happens before Sunday being the new deadline. Just some issues just very quickly to pick up on. The Goods Vehicle Movement System, GVMS, which is going to track lorries going into across the channel. That's due to be released on the 23rd of December. Doesn't give a lot of time for working it through and making sure that it works for the customs and freight forwarders. You should have already signed up with customs intermediaries if you are involved in exporting goods, but please do so. The Chambers of Commerce can help with that process as well. Obviously, talking to your suppliers and customers, absolutely key. And as we enter the new year, if you are considering looking to recruit staff from overseas, then you need to start thinking about getting your Home Office licensed sponsor agreement in place. Look out for your likely tariffs, UK general tariffs on imports and WTO tariffs on exports from the EU 27 to the UK. Incoterms, I think I've flagged that before, but where you have got Incoterms in place with customers and suppliers, do make sure they have addressed the issue very clearly in the post-Brexit era as to who is going to pay the duty and tariffs. Because in the EU 28, when we were single market, those clauses didn't matter. If they were included, they really had no relevance whatsoever. They were redundant. Unfortunately, 1st of January, they are going to be very much relevant. And then finally, a little discovery I made regarding wooden crates. Believe it or not, wooden crates need now to be certified from the 1st of January as they cross the channel. And there is a certification mark, and you just need to make sure that your freight forwarders, and if you deal with crates yourselves, you should be aware that they need to comply with an ISPM 15 guideline. Otherwise, the goods will not be accepted. So it is a significant issue for shipping goods into the EU from the 1st of January. So that's quite apart from everything else that we have to deal with. We've got to make sure they're on the right sort of pallets. That's it for now. Watch this space. We will be releasing some more information, obviously, as it comes to light, and we will do some video reports on the outcome of Sunday's final negotiations if it gets anywhere. Okay, thanks, Mandy. I'll hand it over to Gregory.
Okay, thank you, Paul. Good morning. Can you hear me all right? How's the sound? All okay? Brilliant. Okay. Warm welcome to our Around the World talk. My name is Gregory Perdon, and I serve as Co-Chief Investment Officer at Arbuthnot Latham in London. Now, my objective over the course of the next few minutes is to take you on a tour around the world to talk to you about the mega trends which are impacting global markets, the economy, and some of the main key business sectors. So rules of the road are simple. We're going to keep it short, sharp, under 15 minutes. That way there's plenty of time for Q&A. And we're going to leave off any financial jargon because that will just switch you off. Okay, fine. So let's get started. As always, it's good to be back. We're going to start off in the US of A, the world's largest economy. Now you have to hand it to CNN. Their coverage of the US elections was impeccable, and it wasn't addictive, that magic wall. I certainly thought it was. It appears that Donald Trump is almost kind of like a distant memory. But what does that teach us? Well, that emotional volatility from a market's perspective has this tendency to recede and revert back to the mean very quickly, which maybe is not a bad thing. Lesson to us, let's focus on the signals and avoid the noise, something I always remind myself of when I step into our quarterly investment committee. So what does 2021 have in store? Let's talk about the Biden-Harris future administration. Let's take each in turn. Okay, definitely a policy reset. I think that's pretty obvious. Perhaps what's less obvious is the fact that Biden is recycling lots of Obama personnel back into administration, which may not necessarily be a good thing. Certainly very talented individuals, but those are some of the individuals that set us up for the Trump administration. So my advice to Biden and Harris would be to diversify some of their personnel a little bit. Certainly next year is going to be a lot less entertaining with much less saber rattling on Twitter, but that's probably a good thing. Speaking of China, there's consensus that that there is bipartisan support for continuing to keep a tough stance on China from American perspective. I'm not so sure that's really what's going to happen. The reality is that when you speak to US companies, their main complaint is all about corporate access. I would wager to say that Biden, on the surface, has a tough stance, keeps a tough stance on China, but underneath takes a more dovish position in exchange for more corporate access for US companies to grow overseas. Let's talk a little about the fiscal stimulus and the prospect for that. We're aware that, of course, America, a very litigious society. One of the things holding the stimulus package up is the fact that certain parties want there to be indemnities around corona infections from business perspective, and other parties don't want it. Let's put that debate to the side for 1 second. I think there's two key things to be looking at. when we're looking at the prospect for additional fiscal stimulus. One, a little bit of a red herring, and that's the infrastructure angle. Infrastructure obviously would be brilliant because if, I don't know if the last time you went to America, but the infrastructure is pretty diabolical. So the Americans definitely need a few more bridges and tunnels and some new motorways. Having said that, what we really need in America is a continuation of the unemployment insurance. For those of you who know, in America, there really is no such thing as a social safety net, but that changed with Corona crisis. And actually, we've seen some pretty generous handouts from the US government to everyday people. So why? They could continue buying coffees at Starbucks and so that the GDP wouldn't completely go off road. Right. Let's move to monetary. Usually I spend a lot of time talking about monetary policy, but this time I'll focus just a touch on the US Treasury. So there's a rumor going around the US Treasury is going to merge with the Federal Reserve. I'm kidding, of course, that's not going to happen. However, who do we have that's potentially going to be running the Treasury as of next year? Well, Janet Yellen. Who is Janet Yellen? Well, Janet Yellen used to be the chairperson of the Federal Reserve. So there's going to be a lot of rainbows and high fives in between the Federal Reserve and the Treasury next year, which is probably good for markets. What we don't want is we don't want the Treasury and the Federal Reserve locking horns like they did only a couple of weeks ago. Let's move on to the IRS. The IRS is the American equivalent to the HMRC. A lot of consensus around the fact that Biden is going to raise corporate taxes. Well, I'm not sure he's going to do that in the short run, maybe in the long run. In the short run, we have to remind ourselves that we are in a pandemic, and if you raise corporate taxes, that's going to squeeze corporate margins, which probably won't be good for earnings, which would be bad for the stock market. So yeah, probably corporate taxes will go up, but not in the short run. Let's keep the conversation going in terms of some of the sectors as we head to California. A lot of talk now for a couple of years whether there's going to be an increase in tech regulation. And there's certainly the assumption that there'll be more tech regulation under a Democratic government than under a Republican-controlled government, excuse me. The reality is that I would venture to say that Biden probably doesn't rock the boat. He'll leave all those new tech regulations for the Europeans to be the trailblazers. And let's remind ourselves that Biden is very much a centrist and doesn't want to kill the golden goose, which certainly big tech is in America. Let's head to Texas for a second and talk about energy and energy policy. It's true, the US will rejoin some of the organizations which have either been vexed or have been exited over the course of the past few years under Trump. Having said that, energy could be an interesting one. And we're going to return to this theme in today's talk on a number of occasions. Energy stocks fall under what's called the value stock complex. And energy stocks are certainly out of favor. Why? Because they're not very ESG, and we know ESG is taking over. Secondly, the fact that because there's less mobility, less travel, less flights in the air, of course, there's less oil consumption. So energy stocks have really been the dogs. I wouldn't necessarily write them off just yet. The reason I wouldn't do that is because big energy, these companies are probably on a course to reinvent themselves and transform themselves from dirty big energy into more cleaner technologies. So I would just I'm urging our investors in conversations, not necessarily to write off that sector just yet. All right, let's leave the US behind and let's cross the pond. Let's come back home to the UK. And I have to admit, the headlines have been rather diabolical. It's difficult to get away from all the negative headlines in the UK on a daily basis. We had the Chancellor's spending review. We know 96 or 94 billion pounds. We know the OBR's financial projections in terms of outstanding gilts by 2022 of circa 2.2 trillion. Those are some pretty negative numbers. That on top of the fact that we've all the controversy over the tier 1, tier 2, tier 3, the lockdowns, it all makes for a pretty depressing story. But just because the story is depressing doesn't necessarily mean that there's no investment opportunities. Right. So what are we looking at? We're looking very carefully at the debate between growth and value. And I promise no technical jargon, so I'm going to keep my promise, but just bear with me for 1 second. Over the course of the past couple of years, the growth sector, so technology stocks such as, has outperformed dramatically the value sector. And what are value stocks? Things like banks and energy companies. And recently, and more specifically, when we announced when the announcement of the vaccines were made, all of a sudden, some of the old world economy value stocks started to rally significantly. Why is that? Well, because these are the exact stocks which will benefit if we do indeed start to see a recovery. So what does that mean? Well, the big question is whether this rotation is actually going to have legs, yes or no. That's the biggest question on investors' minds today. So how are we investigating this question at our investment committee? Well, we're looking at two things. Number one we're looking at is the value of the US Treasury 10-year bond. Why is that? And also we're looking at the value and the level of the pound, which will go into Brexit in a second. Feels a little bit left field. Let me explain why we're focusing on the 10-year Treasury for guidance and clues into whether this sector rotation will actually have legs. Let's start with a little bit of a reminder. The reminder is that the equity market doesn't make the world go round. It's the bond market that's much more important. Why is it that the jocks go work in the equity departments when they graduate from uni, and the smart guys and the nerds go work in the credit department? It's because the credit department has much more impact on the global economy. You don't need stocks to go up for companies to grow, but what you do need is you need a healthy lending environment. You need the bond market to function. Hence the reason why the bond market is so important. So if we see an increase in yield in the US Treasury, what's the market telling us? It's telling us that economically sensitive stocks actually might do better. What do I mean by that? And can I prove and can I support that statement? Okay, well, if there's more planes in the air, that means there's more fuel being consumed. And if there's more fuel being consumed, chances are that means energy companies will do better. What about the financial services and the banking sector? Okay, well, if long-term rates are higher than short-term rates, what's the basic business model of a bank? Well, they borrow short and they lend long. Hence, the opportunity to make money is much higher, right? Which of the geographies have lots of value type stocks in their indices? Europe, UK, and Japan. We'll come back to those countries in a second. Let's talk quickly on the pound and tie into some of Paul's comments in terms of Brexit. Ever since we voted out, the pound has been in no man's land, and international investors have struggled to allocate to the UK investments just because of fear of further pound weakness. But if we start to see a little bit of Brexit magic, all of a sudden we could start to see the pound appreciate, and that could give the green light to international investors to start to take a bigger position in UK assets. And of course, as I mentioned earlier, many of the stocks that are in the main indices of the UK tend to be value stocks. So it all comes full circle. So if you ask me, what do I want for Christmas? It's simple. I want the 10-year Treasury to be trading at 1.25. And I'd like a little bit of Brexit, Brexit magic so that we can hopefully see the pound a little bit higher. By the way, we're positioned in our discretionary portfolios to benefit from both those scenarios. Let's head to the continent for a second. I have to admit, it's a bit difficult being a Frenchman living in London these days. South Ken is a ghost town. And perhaps one of the reasons why I'm going to be applying for my British passport. That way, hopefully, I'll be able to blend in a little bit better. But I have to say, it's not that much better in France either. Corona crisis has really been very, very difficult. And the economic damage has been very significant, which of course is difficult to bear. What has been the policy response from the European governments? Well, a fiscal monetary 1-2 punch, and it's been pretty significant. We're all aware that the Germans have ditched their black zero, which was a big event, but the Europeans are taking it to the thing for debt mutualization. What do I mean by that? Well, the European Commission has authorized the issuance of bonds to the tune of 750 billion euros worth of paper under their program called EU Next Generation. What's the purpose? Well, the purpose is to help social upgrades, digitalization, and to support sustainability. Those are all very good things. But the reality is that this is actually going to be, have a significant impact on European integration. So for all those people that have been calling for the disintegration of Europe, actually this is a major development. And it's further supported by what we're seeing out of the ECB. So like I said, a 1-2 punch, fiscal and monetary simultaneously, supported by the leader of the ECB, Christine Lagarde, in her superhero outfit, has come out and provide a tremendous amount of monetary support. And she probably will do the same again and increase that support in this week's meetings. I'll just deviate for 1 second and just remind the audience a little bit about what this monetary support actually is. Many investors falsely believe that the ECB is printing money. What they're actually doing is they're buying bonds and exchanging them for cash. Cash, what that does is it liquefies the market. You're not just creating cash. Cash already exists. What you're doing is you're helping to create liquidity in the market. So will it work? Well, of course, no one knows, but I wouldn't bet against Europe at this juncture in time. The amount of stimulus from a fiscal and a monetary perspective going into the continent is significant. So you'd be a brave man or woman to bet against that. Let's leave Europe behind and let's travel to Asia, and then we'll close and hand it back to Mandy for Q&A. Right, so last time we did a talk with Kingston Smith, we focused a lot on Japan and less on China. Today we'll do the opposite. We'll focus a little bit more on China and less on Japan. So in terms of China, the bottom line is that President Xi deserves some congratulations. He orchestrated the perfect V-shape. So what are some of the details? Oh, sorry, and by the way, this was further supported by recent economic data in the form of manufacturing PMIs, that indeed the Chinese economy is on terra firma. What are some of the details? Well, what we've seen is a rolling over of the savings rate, which result in an uptick in consumption, which was one of the key points. We've seen a credit expansion in line, which helps a recovering economy. And of course, the government has remained accommodative. But, and there's always a but, isn't that frustrating? There's always a but. But we've seen short-term interest rates rise and the currency appreciate, both which could potentially serve as wrenches or in the spokes, so to speak. And if you turn to the history books, it's good to compare the response from the government coming out of the GFC back in 2010 to today's response. China tightened too quickly, but part of the reason they did was because actually the economy was red hot back in 2010 because there was too much stimulus. So they've certainly learned their lesson. Looking forward, it appears that China is on even keel, and the policy officials are very mindful of what's going on. What does that mean? Going full circle, a la Alchemist, that could spell a positive bump for things like commodity sector and for cyclically sensitive sectors like banking and energy companies, like I mentioned earlier. Let's touch just briefly on Japan before we close and move to Q&A. We touched last time on the fact that there was a little bit of uncertainty after Abe stepped down. Would the new PM, Suga, be able to take up the helm? And that's uncertainty around that is certainly behind us. And I think there's a lot of proof now that Suga is definitely cut from the same cloth as Abe. The big question mark, of course, is we've got elections coming up only a few months away. And now, what's happening? Well, it's interesting to observe that Suga and company is actually issuing their third supplementary budget in terms of fiscal support. Now, I'm not suggesting they're buying votes, but maybe not a million miles away. We're bullish on Japanese stocks. We own them in portfolios, and we expect good things from Japanese equities in the coming months. With that, I'll close the tour around the world. I'll hand it back to Mandy, and I will say thank you very much for tuning in.
Gregory, thank you very much indeed. That was absolutely fascinating. I should have mentioned at the top that Paul unfortunately has got to leave slightly early to disappear off and be on a different webinar. But any questions posted for Paul in the chat we'll follow up with. Gregory, a couple of questions that came in advance that I'd like to run past you. I've got one for Tim in a minute. Would you invest in Bitcoin?
Right. Okay. So Bitcoin, it's something we looked at about 2 years ago. And one of the reasons why we said no was not because we didn't think it was a good idea, was just because we couldn't figure out whether it was actually safe to hold. And thankfully, we did give it a pass at the time, because there were subsequently quite a bit of controversy over the stability and the safeness and how you can actually hold it. A lot of that's actually changing now, and a lot of institutions are now finding ways to replicate the performance of Bitcoin in a safe format. I'll admit there's quite a lot of speculative forces in that market, but in light of the fact that there's a finite number of coins available, and now it's becoming safer to hold, so to speak, from a security perspective, it's now becoming something which is back on our radar. The question, of course, is, has there already been too much speculative and animal spirits in that market so far? That's something our investment committee will be looking at. So on the radar screen, we're not in it just yet. No,
really interesting, because it always seems to me that other currencies have got something behind them, whereas Bitcoin is just kind of a theory. So which has always slightly put me off. But I've got a question now for Tim. The Chancellor has all but withdrawn entrepreneurs' relief, and the Office for Tax Simplification is recommending that capital gains tax is increased to 40%. So an entrepreneur who's patiently built their business over a decade or more in the belief that they would be paying £1 million in tax on a 10 million sale would face paying 4 million. Does the panel believe, and the panel in this instance is you, Tim, that this will happen? And what do you think is the likelihood of the government introducing something along the lines of taper relief, which at the outset required people to own, to be employed in the business and hold their shares for 6 years?
Okay, I mean, that question probably comes in multiple times every day at the moment, as it's very much front and center of people's minds. Taking those in order, do I think it will happen? Yes, I think capital gains tax will go up. Then the big question is when. In the spending review, the Chancellor, I think, mentioned the word tax twice, and one of those was cancel tax. I mean, he studiously ignored giving any more hints about what would happen. But in the OBR report that came out the same day, all 250 odd pages of it, it said quite plainly we need to raise 46 billion of tax or have 46 billion of spending cuts just to stand still on the deficit. The capital gains tax in the OTS report said, well, on a really rosy day, if you align capital gains tax with income tax rates, it would raise 14 billion a year. But in the next breath, the OTS said that won't happen because people would just change their behaviours. So will it happen? I think there is still a really genuine fear it will happen from the 6th of April that capital gains tax will go up. My money is on going to 30%, but there's a growing sort of discussion around delaying the tax increases until the V-shaped recovery is established, which means that would kick the changes back a year. Rishi Sunak is a really smart guy. The best way to raise taxes is to say, in the future, I'm going to put them up. So when the 50% tax rate came in, there was a bumper tax action in the run up to the 50% rate. We had lots of notice and everybody paid themselves dividends. Capital gains at the moment, people are selling things, whether it's real estate or stocks and shares, they're selling it like the world's about to end. So there's a bit of me that thinks the CGT increase may not happen until April 2022, but I would plan for it happening in April 21. I don't think there'll be a return to taper relief. I think it was another element of the question. We might get a return to indexation, but indexation doesn't help you when you've got shares in a company with a low base cost. Help you on the arithmetic for that if that's not clear. So probably will happen, probably won't go to income tax rates. Plan for it happening in April 21, but optimistically April 22.
Tim, that's great.
Yep.
Thank you very
Thank
much.
you
Paul,
very
I
much.
think that's a wave goodbye.
All
Thank you very
best,
much indeed for joining us. Good luck with the next one.
And stay safe.
Thanks, Paul. So Gregory, another question for you. Are there any emerging market opportunities?
Okay, so that's always a difficult one because the emerging markets is so big. Just to tie into bits of the talk, one of the second derivatives of China doing well are countries like Australia and Brazil. Now, we're all aware that there's a little bit of tensions between Australia and China, so that might necessarily be the second derivative. But Brazil could be a second derivative that could benefit from China recovering. And I don't think there's a lot of economists out there that would make the case that China is not recovering. So if you tie Brazil's future economic prospects to a Chinese recovery, that's probably a decent bet where you're not taking a lot of political bets, because obviously in emerging markets, and especially in frontier markets, often you're taking political bets, which investors like us never like to do. So Brazil is definitely one place that we are putting our research efforts into, and should benefit from a rising of the boats as the tide rise, if you follow me. Hope that makes sense.
Yeah, that makes total sense. Thank you very much. I think we've got time for a couple more questions before we close. Do you think the ECB is going to forgive Italian debt?
Okay, so that is a very tricky question. And the reality is that Christine Lagarde there's a bit of a controversy there, in that it was actually a low-level Italian government official who made that suggestion. And Christine Lagarde, who is the head of the ECB, quickly batted back and basically said, look, go take a hike. It's illegal. It's not going to happen. The reality is that we enter into the world of helicopter money. And helicopter money, the problem with helicopter money is that in many instances, it's actually illegal. So you'd have to change the law in order to incorporate it. And also, once you do that, central banks, there's the prospect of them operating under the specter of negative equity, which we all know it doesn't build confidence. What's good for financial markets is to have a central bank which has the credibility, is run by good, strong governance. They have a strong command over the tools which are in their toolbox. And by just trying to forgive with a magic wand significant parts of the bond market, it doesn't, in my opinion, add a lot of stability to the future. So I just don't see that happening in the short run, although it did make all the headlines for a couple of days on end.
Oh, yeah, absolutely. No, it was the talk of the town, wasn't it? Final question, I think, unless any more get posted. Will the US dollar really depreciate in 2021?
Okay, Mandy, so just in terms of the US dollar, historically, I've always been very cautious about betting against the dollar. And the reason that is because it really, truly is the international safe haven a currency. If you want, in a crisis situation, investors tend to gravitate either to the Japanese yen, the Swiss franc, or the dollar. The difference with the dollar is that actually it supports two of the biggest markets in the world, which is the US Treasury market and the US mortgage bond market. And the reality is that's not going to change anytime soon. It's true the yuan in China is becoming more internationally recognized. It's true that the euro is a very significant currency, but so far no one's been able to knock the dollar off of its throne, so to speak. So I've always cautioned against betting against the US dollar. Having said that, now that Biden's in the White House, I actually do believe that Biden is dollar negative. And what I mean by that is that the Biden administration will most likely increase government bond issuance. And what you actually do when you issue a lot of new bonds, it's kind of a way of devaluing your currency a little bit, because you're basically flooding the market with that paper. So for the first time in a long time, I am dollar negative, not too negative, because you need a significant catalyst to knock it off its throne. And I just don't see that happening anytime soon. But on the flip side, I'm actually quite positive on the British pound for some of the reasons I mentioned earlier. So actually one of the foreign exchange we call crosses, which I think is worth consideration, and we've actually have this position in the portfolio, is to own the pound against the dollar. So yes, dollar weakness, and we believe there'll be sterling strength. And the basis of our view on sterling strength is all about the prisoner's dilemma between the UK and Brussels. Both parties economically, forget politically, but economically will be better off with some form of a deal.
Okay, that's really interesting. Yeah, really interesting. Thank you. We got a couple more questions posted. I thought we'd run dry, but we haven't. First one, this is, I think, a little bit tricky to answer, but I'd love your views. Is there any possibility for some governments to claim reparations from the Chinese Communist Party for COVID damage?
Wow. That's a hard one. I mean, I think that the short answer is probably, I mean, in what jurisdiction, how would that be governed? How would that actually even happen? I mean, I think the reality is, if someone's really angry about COVID, then just stop doing business with the counterparty. It's as simple as that. And you can do that by deciding what stocks you want to own, what bonds you want to own, what banks you want to bank with, where you want to put your deposits, which products and services you want to buy. And so I think there's other ways, if you want to, inverted commas, try to punish a counterparty. Probably the strongest way these days to punish a counterparty is just take your business elsewhere.
Yeah. Okay. Thank you. That was a tricky one. Sorry, it was curveball. I've got another here. I attended a presentation recently which speculated that no deal Brexit, which would push the pound towards 1-to-1 with the US dollar. Do you share that view?
I do think if there's no magic on Sunday night, there will be some pound weakness. I think that's fair. I think we are coming to the end of the line. I'm not a political strategist. I only focus on financial markets, so currencies, fixed income and equities and funds. But I do think that there is always a risk that if we come to no agreement, which I do think will be detrimental from the economic perspective to both parties. Hence the reason why I do think there'll be some kind of deal, whether it's skinny or a little bit skinny or not so skinny, who knows, that will actually transpire. But no, I do think the viewer, sorry, the individual in the audience that has pointed that out is absolutely correct in assuming that if there is no deal, sterling will take a tumble, because there are already lots of investors positioned to benefit from some sort of deal. I think the probabilities are there's 80% probability of some form of deal. So it's kind of four, if there's 5 investors, there's kind of 4 that think there will be a deal and 1 that won't. So I think your viewer is correct that there will be some downside if nothing emerges.
Okay, thank you. I certainly hope the 80% are going to be proved right. Final question, unless something else gets posted. For you, Gregory, again, heading into 2021, what are your views on the credit markets?
Okay, so one of the areas, there's been 2 areas that we've made good money this year, in credit specifically, and that's been in the bonds issued by European banks, because they really sold off during the March sell-off, and also in US mortgages. And I have to say, we got a little bit of press around our calls in the US mortgages earlier in the year. And I have to say, I always said to the journalists, I said, you shouldn't be giving us this much credit, because actually this is not a particularly imaginative investment. The Federal Reserve, which is the 800-pound gorilla of the market, is buying mortgages. So all we're doing is just standing in the same market with the biggest investor in the world. So this is not particularly imaginative. And from experience, those type of strategies tend to work if you're in the same room as the biggest investor in the world. So we have made money in mortgages, in credit, and there's certainly a little bit more money to be made. However, I would caution not to be too overly optimistic. If you look at, for example, US high yield credit spreads, they're trading at now under 400 basis points over, which is good, but it feels like a lot of the easy money, inverted commas, has already been made. So probably some of our I think the best performing investments will probably be in this value rotation, which again would benefit sectors like banks and energy in geographies like Europe, the UK, and Japan.
Okay, thank you. I've got another question. Should we stay invested in gold considering the recent market rally?
Okay, that's a tough one, because there's gold, there's gold producers, there's quite a bit around gold. The bottom line is that chances are quantitative easing will continue. I just don't see a situation where in the next 3 years, the Bank of Japan, the Bank of England, the ECB, and the Federal Reserve recede from quantitative easing. And generally speaking, gold benefits from quantitative easing. Now, the counter argument to that is that if interest rates rise, that's actually also negative for gold, because then all of a sudden you don't need to hold gold. You can hold a piece of a treasury bond, which will actually pay you something. I think my gut feeling tells me that there's still some value in holding gold, also because it does provide a form of a hedge. My preference would probably be for the gold producers as opposed to just the underlying commodity, just because they can actually make money. So you could own the equity in a market where equities are actually doing all right. So kind of, the expression eating your cake and having it too, or eating your cake and eating it
having
too.
your cake and eating it. Yeah,
exactly. There you go.
That sounds great. All right. Well, I'm off to go and buy some mining stocks then. Listen, thank you very much indeed, Gregory. That was, as ever, really fascinating and truly helpful for our audience. Thank you very much to Tim too for dealing with the questions on tax, and to Paul in his absence for dealing with the slightly harder questions on Brexit. Thank you very much to everybody for joining us. As I said at the top, we will be sending out a link to the recording, a copy of the slides, and a copy of the answered Q&As, and a feedback poll. And I'd be really grateful if you'd just take a minute to fill in the feedback poll so we know how we're doing.